Good morning, everyone. I need to draw your attention to this important notice before we start our proceedings. I am Michael Forsyth. I'm Chairman of Secure Trust Bank. And can I thank you all for taking the time to join us this morning, both in person and online. And it's great actually to see people in person. I just want to make some brief remarks about Secure Trust ahead of David and his team presenting to you. As chairman, I've been hugely impressed and proud of how much the bank has achieved, but I fear we've been hiding our light under a bushel for far too long. Hence today, and our first ever capital markets presentation under a new management, and a chance for us to share our insights, enthusiasm, and plans for this diverse specialist business. The last couple of years have, of course, been really difficult for everyone, and the board decided early in the pandemic to focus on supporting our existing customers, keeping our staff safe, and preserving our capital. And with the energetic support of our colleagues, we succeeded. Our financial results in unprecedented times have surprised everyone, perhaps even ourselves. We exceeded our we executed our leadership succession plan at the start of 2021, and the board has been impressed with how smoothly that transition has been delivered. New senior executives have been appointed. New senior executives have been appointed to strengthen the team, and there is a fresh momentum in the business and a determination to seize the opportunities as the economy recovers. I promised earlier this year that our future strategy would be more evolution than revolution. And as you will hear shortly from David, I may have understated that. We know where we're going, and we know how to get there. We have a consistent and reliable record in respect of our dividend policy over the years, and our new policy to return 25% of earnings to shareholders reflects the board's confidence in our significant growth prospects. Our board is experienced and diverse, and the company is fully compliant with the UK Corporate Governance Code and retains a positive and supportive relationship with our regulators, as you would expect. With a new team, relentless focus, and a clear strategy, we have much to look forward to, and today really is about the future. You will meet our management team, who will share more information with you and shine a light on our individual specialist businesses and their prospects going forward. They have ambitious and achievable growth plans as the bank returns to growth. So let us begin with our Chief Executive, David McCready.
Thank you, Michael. And good morning, everyone. It's great, as Michael says, to finally meet those of you in the room who have not met face-to-face before. Certainly recognise some of the faces from the many Teams calls, but great to actually get together. So thank you for being here, and thank you also for those who are joining the webcast for this, as Michael says, our first Capital Markets Day presentation. We're really excited to be here. We are delighted to have the opportunity to share more today about our plans and ambitions for the future for Secure Trust in the coming years. We'll share more information than you've ever heard about our businesses before and give you much more clarity on where we're going. We've successfully navigated the impacts of the pandemic, as you know, and we're well positioned to pursue our strategic objectives and build on the momentum that was evidenced in our Q3 trading statement. New business was up 59% in the quarter compared to the previous year, and of course 7% growth in total lending as well, despite the impact of the Q1 pandemic lockdown. Today we'll demonstrate where we see the many opportunities across our diverse specialist businesses to build on the momentum that the team has created. If I first of all just look at the running order for this morning, there's roughly about 2 hours of presentations. We had pretty strong feedback, don't go above that, so we'll try and stick to it. We will have a break after the business unit presentations have been completed around 11:30, and then Rachel and I will make some comments on funding, capital and concluding remarks. But there are a number of important objectives we want to achieve. I'll share with you the new group vision, core purpose and strategic themes that we've developed as a team. And I'll also provide new guidance on our ambitions for loan book growth, and I'll come on to that shortly. But that will also allow me to summarise the key capabilities that support the confidence we have in delivering all of the group's medium-term targets. Of course, a key objective today is to introduce you to more of the team. They will talk to you about their businesses, bring them to life, explain their relative market positions, and also how they support the delivery of the group's strategic objectives. Key themes will be excellent market positions, specialist capabilities, and our excellent growth prospects. Rachel will then, as I say, update on funding capital before we close and then have a Q&A. For those in the room, we'll also have a lunch organised in the breakout area, and we'd be more than happy to spend more time talking to you then and to see and meet more of the wider team. I'm proud of the depth and breadth of the management team, with their experience spanning a diverse range of backgrounds. We've made a number of important changes to the team this year, and 5 of the 10 colleagues that are shown on the slide are actually new to the group. As you know, Rachel took up her role as Chief Financial Officer in September 2020, and myself and other new colleagues joined the group in the first half of this year. The 4 business leaders on my team who will present today have actually been with the group for a number of years, and this has certainly helped with the smooth leadership transition that Michael referenced. So there's an experienced team, but a fresh team with new ideas and a clear view of how they take the group forward. Those with a green circle around our pictures will be presenting today. Those with the blue are also here in the room and will be in the breakout area afterwards. In terms of fresh talent, though, Chris Harper joined the group as Chief Risk Officer in April 2021, having held the same position at RBS International prior to joining us. And Katie Doherty joined as Chief Operating Officer, having held a similar position with HSBC's retail and wealth management business in Sydney, Australia, prior to joining us. So, lots of fresh talent in the team. Let me turn to give you some insight into the output of the work we've completed on our vision, purpose, and strategy. A decade ago, a vision for the group was developed, and that has served us well. But things have got to change. The market has changed, customers' expectations and needs have changed, and so we must also evolve. We have a privileged market position operating in a number of specialist lending segments, and as a result, we've defined a new aspirational vision to become the most trusted specialist lender in the UK. To achieve that vision, we will, of course, need to have clarity of our reason for being, our core purpose. Having reviewed for myself and discussed with colleagues what it is we're doing when we are at our best, then we are pretty clear we're actually helping our customers, both large and small, to achieve those ambitions of their own. We develop and deliver propositions and make sure that the process of dealing with us is as simple and as straightforward as possible, and that will remain a key feature going forward. So we've defined that purpose as to help more consumers and businesses fulfil their ambitions. The use of the word more is deliberate to give a nod to our clear growth, aspirations and ambitions. So what gives us confidence that we'll be able to deliver against that purpose consistently going forward? Well, the strengths that you can see on the slide and which will be brought to life by each of the business unit presenters today will be the foundations that we build on. Our specialism, expertise, diversity and ambition will all shine through. Let me turn to the refresh strategy and the specific objectives that we will be focused on delivering as we pursue that longer-term vision. We've categorised these under 3 strategic themes: grow, sustain, care. Under grow, we will be looking to have our primary focus on organic growth in these attractive specialist segments. You'll hear today that we're typically a small player in our markets with lots of opportunities to grow ahead of us. We'll continue to improve and exploit our digital and technology capabilities and look to serve more customers and to become more cost efficient. We'll use our deep market expertise and customer knowledge to create sustainable value for our business and shareholders, and we'll continue to be disciplined in our allocation of capital and also to continue to operate strong risk management disciplines within our existing risk appetite. And as you know, we've been improving the quality of the lending book over recent years. We will help more customers by designing and offering simple, clear and compelling products. And actually, you'll hear new examples today of a number of new product launches that we have planned. And we'll continually be looking to improve our experience that we deliver, when customers interact with us. And again, technology will be a key theme you hear about today. I am confident that by focusing on these strategic themes and on these objectives, that we'll be able to, and with always acting with integrity and transparency, we'll be able to move towards those longer-term ambitions. Of course, we operate across a diverse number of business segments in both consumer finance and business finance. We don't have time to focus on all of the business units today, so the focus is on the 4 business units that represent 96% of our total lending at the end of June, and actually the vast majority of our growth going forward. In the green boxes are the consumer businesses, and we'll focus today on retail finance and vehicle finance. They operate under different brands, as you can see on the screen, and at the end of June, they had balances of just over 900 million. In the purple boxes, the 2 business units in the business finance segment, real estate finance and commercial finance. These actually operate under the Secure Trust Bank brand name, and at the end of June had balances approaching 1.3 billion. I thought this would be a helpful slide to show, just to bring to life what we do and how we help across the different business units, and also how they all fit into supporting the new core purpose that we've developed. You can also just read these on the screen, and we won't go through some of the detail that the business unit heads will go through shortly, but just to call out a couple of things that we often get asked questions about. So in vehicle finance, we're helping customers with their finance solutions for used vehicles only, not new vehicles. And in real estate finance, we actually are helping and supporting professional property investors and developers. And you'll hear more about those businesses from David and John shortly. A quick slide from me just to highlight why I believe that Secure Trust represents such an attractive investment opportunity. We have got a real focus on attractive and specialist markets. As we will come on to cover in more detail, we've got a diverse portfolio of businesses across both consumer and business finance. We have strong market expertise, relationships, and of course our technology and digital capabilities that you'll hear more about today will also be a key feature going forward. We'll continue to be focused on our rigorous credit discipline and making sure that all risks are managed appropriately across the group. But we do see clear opportunities for growth and a strategy for creating longer-term value for our shareholders. Main focus, organic, but of course we will consider any opportunities for value-added M&A. These strengths really are why I'm so confident we will move towards our medium-term targets. And I've put the slide up just to remind you of what those 4 targets were on the left and centre of the slide. But today we are actually introducing a new 5th target to give you some sense of our ambition for lending book growth. So we will be looking to deliver a lending book CAGR of 15% plus. So it's a new growth target. We've taken on board the feedback that we've not been clear on where that direction of travel has been for our ambition on lending growth, and hopefully that helps you today to understand that ambition. And the whole purpose of the presentations will be to bring to life all the opportunities we have to move towards that medium-term target. So with that, we'll move into the business unit presentations. And first of all, I'd like to introduce Nick Davies, CEO of V12 Retail Finance, to take you through his business and his ambition for it. Thank you.
Thank you, David, and good morning, everyone. My name is Nick Davies, and I lead Secure Trust's Retail Finance Division, which trades under the V12 Retail Finance brand. This morning, I'm going to speak to you about our business, and in particular how we've grown it in recent years, and how we're confident that we can continue that growth into the future. V12's core model is to provide point-of-sale credit to UK consumers via a network of our retail partners. We operate across a wide range of retail sectors, with our primary lending product being an interest-free loan. Central to our success has been our in-house developed proprietary software systems, which we use to process customer credit applications and which is integrated with retailers right across all of their different sales channels. Our user-friendly customer application is designed to be completed within a couple of minutes, and we're able to provide an automated credit decision in a couple of seconds in about 90% of those cases. The software, it was actually created by us almost 20 years ago now, and was responsible for some of the earliest credit transactions, financing retail sales on the internet. And we've been continually developing that product ever since. In fact, the original developer of the software is still very much part of our business, and he is acting as our IT director at V12 today. He leads our team of in-house developers and continually to be the driving force behind the development of our own software. This is the reason why our system is particularly effective in handling transactions today, which is on the internet, and which is why the majority of our lending is conducted in that area. Our strength in providing credit to fund online retail sales also made us very resilient to some of the unique challenges created by the recent pandemic. The closure of high street stores meant the pandemic further accelerated the shift for consumers to buy goods online, which is where V12 were the most strongest in terms of our retail finance proposition. As we move through the slides, I'll explain further why we believe V12 will be able to meet its ambitious growth targets by continuing to grow in our core markets. And I will also announce plans that we have to launch our own digital buy now, pay later product during the first half of 2022, which will provide us with a whole new avenue of growth. But first, I'd like to start by giving you a sense of our customer proposition and showing you a promotional video that we provide to retailers, which is also available to view on our main website.
Hello there. Welcome to V12. Our new simpler application journey offers an intuitive user experience that makes it even easier for your customers to apply for finance. The new user-friendly look and feel gives your customers confidence throughout the application. We've made the key information easier to understand, and for new customers, the journey is even more straightforward, making the application process a breeze and helping to maximize your sales. V12 customers can register to view their account online. This means when they apply with us again, we'll recognize them straight away, and they'll sail through their application even more quickly. We're paperless, so all customers will receive emails from us about their application, helping the environment and getting the important information to them quicker.
You'll note that the video speaks directly to retailers, and this is because our sales model is to build direct relationships with retail partners. These retailers then refer their customers to V12, and we provide credit to fund purchases made via their stores and internet sites. Now, I appreciate I might be somewhat biased in this, but I believe that V12's sales team is the very best in our marketplace. They've proven their worth over many years and have built partnerships with more than 1,400 retailers to date, with many more being added each month. When it comes to point-of-sale credit, a retailer's main requirement is for a frictionless customer journey, which can be easily integrated into their various sales processes. And it's V12's ability to meet these needs using our flexible in-house software that's given us a significant competitive advantage. Our sales team focus will always be on understanding exactly how a retailer's customer's journey works and then identifying ways that V12 software can enhance that journey. We pride ourselves on finding solutions to even the most complex of systems requirements and have integrated ourselves with many different types of retailer systems. This makes us stand out from the competition, many of whom have legacy IT issues to contend with. You'll also note that the video shows the software working across a range of different devices, laptops, mobile phones, tablets, and similar. And this reflects the fact that the system we have works very well across all of the different sales channels. This is becoming increasingly important. The lines between these channels is getting ever more blurred. And as you might imagine, we've seen a steady climb in sales via tablets and mobile devices to a point today where it represents 66% of all of our new applications. These devices are also now used by many retailers in store, so they use tablets and even mobile devices to process credit applications in an in-store environment, further enhancing customer experience in that area. But regardless of the device, to process the initial request, our software funnels them back to V12 in a single uniform format for processing. This makes for a very consistent user experience and also gives us the ability to scale our business in an efficient manner. It's been the full digitalisation of the V12 journey that has made it a very attractive option for both customers and retailers to use. Retail finance is very much a niche market where products have to be simple to understand. As you might imagine, the retailer wants to spend the majority of their time focused on selling their own goods rather than our credit offer. This is even more the case with web sales, where there are obviously no staff present, and where retailers are continually looking for ways to minimise the dropout rate during the application and in the checkout. In line with the rest of our market, our range of products has been limited to fixed-term interest-free and interest-bearing loans for a long time because they are simple and easy for a customer to understand. However, the recent emergence of the buy now, pay later product into the market over the past couple of years has meant that retailers are now more willing to understand and accept innovation in our products. The ability for the buy now, pay later to drive benefits to the retailers through increased sales means that they are now increasingly demanding innovation from their partners. And it's V12's ability to develop its own software and deliver this innovation, which means we're very well placed to meet this particular challenge. Interest-free credit is the dominant product in our marketplace, as retailers use it as a promotional tool to increase their own sales targets. And this is the reason why it makes up more than 80% of all of V12's lending today. Interest-free attracts many customers who don't necessarily need the credit to purchase the goods, as many of them would have been more than capable of paying for it with cash. And it is these prime credit profile borrowers that typically generate lower levels of impairment on this product than any other forms of consumer credit. For this reason, V12 changed its strategy during 2019 to target the acquisition of even more interest-free business. And our success in executing on this strategy can be seen with the increase in the proportion of interest-free lending that we write from 69% to more than 80% today. Our products are designed to accommodate a wide range of retailer goods at different spend levels. And this can differ greatly from retailer to retailer and sector to sector. But as you'll see, our average loan is around the £1,400 mark over a 27-month average term. I'll talk a little later about our plans for digital buy now, pay later, but it's important to stress at this point that our current products don't focus on spend levels below the £500 mark, and which is why the digital buy now, pay later product will be a logical addition to our existing suite of products. V12's growth has significantly outperformed the market in recent years. However, that record was interrupted during 2020 as we saw the impact of lockdowns on retail sales overall. Whilst this has been a frustrating time for all of us, the effect on V12 was somewhat mitigated by our strong position in the online credit market. Many of our retailers saw a surge in their online channels when their shops were closed, and in that area, it was in that area that V12 were the strongest. So we ended up processing more new business than we'd originally anticipated at the beginning of the lockdowns. We've moved quickly to recover lost ground, and I'm pleased to report that we've already returned to growth by the middle of this year. As we slowly return to normal, we're already seeing signs in the market that retailers are becoming more aggressive in their sales strategies, and also as they also seek to recover lost ground that they've made over the last 18 months. And as a result of this, we've seen a significant increase in the number of retailers putting their credit business out to tender as they seek to gain any competitive advantage that's available to them. A common theme within these tenders are greater demands for lenders to provide technology and how that can be used to improve customer journeys within the different sales channels. V12 already had a very strong track record of winning retail tenders, as that formed the backbone of our growth in recent years, so this very much plays to our strengths. As a result, we've recently been successful in acquiring a number of new partnerships through tender wins. And we've also seen increased new business commitments for some of our existing retailers, with many discussions continually underway. Another central pillar to V12's success has been our ability to focus on different retail sectors and develop a unique proposition that's attractive to any retailer operating in that area. Retailers in different sectors tend to have very similar needs, and understanding these and developing a sector-specific approach has allowed us to become the dominant lender in certain areas. One example of this is the football season ticket market, where we have gone from having no market share to a 70% market share in a 3-year period. We did this by identifying the needs of our partners, in this case football clubs, and working with third party, in this case businesses like Ticketmaster, to produce a bespoke solution which has now been adopted by a number of large Premier League clubs. By following this approach, V12 has also established itself as the supplier of choice in many other sectors, including bicycle and jewellery. However, we also remain underrepresented in certain sectors, particularly furniture and home improvements, and it is in these areas that we're now concentrating our sales efforts. In the past couple of months, we've secured notable new business wins in the furniture sector, and this includes our largest ever single contract win with a major high street retailer, which actually only went live this week. Whilst we're always open to looking at new sector opportunities, our strategy will be to continue to focus on our core sectors where we're confident there's sufficient business to match our own ambitious growth targets. It is through the discussions with our retailers in these sectors that we've also identified the need for a buy now, pay later offer. And that could be developed to reflect the subtle differences in each of these sectors. V12 has grown its market share of traditional retail finance by taking a sector-specific approach, and we believe that this strategy will also work well for us when we come to launch our buy now, pay later product. It's no coincidence that V12's growth has come during a period of rapid change within the retail market, with ever-increasing demands from customers for frictionless shopping, less tolerance for slow and outdated online journeys from customers. The pandemic seems to have further accelerated change in this direction, and without any legacy IT issues to hold us back, V12 have the flexibility to give the retailers the tools they need to succeed in this area. Having said that, V12 is also very much a traditional lender, with strong credit risk controls, a long history of treating its customers fairly, and experience of operating within a regulated environment at point of sale. However, it's our ability to combine this traditional lending background with innovative IT solutions that gives us the edge in the market. Buy now, pay later has already disrupted the point of sales credit market, although today it feels like the effect has been mainly within the credit card model, as V12 has not seen any material impact on its lending volumes within our core sectors. To date, the buy now, pay later product has been predominantly seen in the fashion market, which has no history of using traditional fixed-term products. We fully expect the expansion of buy now, pay later to move into our core lending areas, and retailers will be looking to ways to integrate the new product with their existing fixed-term traditional retail finance products. V12 plans to be very much at the forefront of that change, and I will speak later about how we believe we can achieve that. Our retailer partnerships are the bedrock of our success, so I'm very proud to share with you just one example of feedback we've received from one of our major partners. You'll note that the points being highlighted are their focus on improving the customer journey and how V12 can help support that. This is also reflected in similar feedback that we receive from right across our retailer base. I've already spoken about V12's sales and systems capability. However, in line with our grow, sustain and care strategy, it's equally important that we have robust and efficient operating platforms that can support our expansion plans. Behind everything that we do are 220 of my dedicated colleagues who are either based in our Cardiff offices or who are still working from home as we continue to evolve our COVID protocols. Our South Wales base is situated within a financial services hub with many local financial service employers providing a strong and large pool of experienced staff. We've been successful in attracting the very best candidates to work at V12, and our growth has created many opportunities for promotion, ensuring that they're able to also retain them as they develop their careers within the business. Many have progressed into our senior management team, which is led by a 5-person ExCo group. Our ExCo alone has combined experience of more than 80 years in the very niche point-of-sale credit sector in the UK. And this spans a range of disciplines, providing a high level of specialist expertise in our chosen market. Having experienced a period of rapid growth, we fully understand the pressures that increased volumes can bring to bear on a business, and we've invested a lot of time and resource in developing highly automated customer services systems. At the centre of this is our in-house development of an online customer portal, which allows customers to access details of their account via the web. It's available 24 hours a day and can be used to complete a whole range of transactions, and it's proven to be a great success, with customers using this self-service portal to transact more than 75% of all of our daily transactions a day. This has improved our service to the customers, whilst at the same time bringing cost benefits to the business. There's never been a more important time for us to care for our staff and the service we provide to our retailers. So during the very early stages of the first lockdown, we moved quickly to a working from home model. Through the hard work and commitment of our staff, we were able to not only sustain the service levels expected of us from our retailers and customers, but within a matter of weeks, we'd fine-tune the operational process that it was having virtually no impact on the way that we transacted. V12's ambition is to simply continue where we left off prior to the pandemic interruption last year by further growing our market share. We're confident that our winning formula of continually evolving our IT solutions while focusing on our market sectors where we have extensive experience will deliver that growth. We certainly have no intention of resting on our laurels, and we view the disruption in the retail markets caused by the pandemic as a chance to V12 to yet again demonstrate its ability to adapt and win. V12 has more than 840,000 live customer accounts, and it's through discussions with those customers that it became clear that many of them are using the Buy Now Pay Later product that's available primarily in the fashion sector. So, to ensure that we can meet all of their product needs when shopping in our core sectors, we feel now is the right time for us to develop our own Buy Now Pay Later product. The Buy Now Pay Later product has firmly established itself in the UK with a simple, easy to use and interest-free features being particularly attractive to consumers. The target market for Buy Now Pay Later is in the £50 to £500 spend range, which would have otherwise been placed on a credit card. Credit cards typically account for the majority of customer purchases made at most retailers, so the potential market for Buy Now Pay Later is huge. The larger ticket spending, which makes up V12's existing business, typically only represents between 50 and 20% of an average retailer's turnover. So the Buy Now Pay Later product would open up a very large new market for us. It will allow V12 to expand its range of products to compete for the more than 80% of retailer sales that would otherwise been placed on a credit card. At present, none of our main competitors in the traditional retail market offer a Buy Now Pay Later product. As such, we believe there are opportunities to win new retailer relationships by offering a one-stop shop for both traditional and point-of-sale credit products. Our ability to offer all of these products will allow us to better protect ourselves from fintech lenders who may wish to move into the more traditional, longer-term lending where V12 currently plays. It's clear that consumers like the ease and simplicity of the product that's in the market today, and V12's own product will adopt many of those features. However, we'll also use some of our market expertise to further evolve that product as we move forward. Our product will be spread over a 4-month repayment term and will be on an interest-free basis, and it will be available for repeat future use with any V12 retailer who have adopted the offer. Unlike the start-up position of many of our fintech competitors, V12 already has more than 1,400 relationships with retailers and more than 840,000 live customer accounts who've previously used a point-of-sale credit product. Our intention is to utilise our existing retailer integrations to make it as simple as possible for the product to be added to the checkouts of our existing retailers. We're also exploring ways that we can promote our offer directly to our large customer base to generate further demand for that product. This two-pronged approach will allow us to gain rapid traction in the market with the new Buy Now Pay Later product. Another key differentiator for us will be our willingness to work collaboratively with retailers to allow them to jointly market their customers who have our Buy Now Pay Later product. Retailers have already expressed their concern that they're working with current fintech lenders. They simply feel that they're handing over control of their customer base and growing the fintech brand rather than their own. V12 will seek to build its own Buy Now Pay Later brand. We'll develop a brand new brand that will sit alongside our existing V12 brand, and it will be very much direct to consumer in its makeup. However, we will work closely with retailers to allay their fears around Buy Now Pay Later. We'll allow them to undertake joint marketing campaigns with us to promote their retail products to our customer base. And we have long-established working relationships with these retailers, so we're confident that our credibility over the years will make us the provider of choice in these areas. Recent announcement over the planned regulation in this sector will further level the playing field for us, and our focus on bringing it initially to our core sectors will also look to dovetail the existing suite of products with our longer-term offers. It's V12's understanding of the subtle differences in these sectors that means we're so well placed to introduce Buy Now Pay Later into these new areas. We're confident that we have the capacity, market knowledge and management bandwidth to ensure we can successfully launch this product next year without losing any momentum in growing our core longer-term lending businesses. So, in conclusion, I'd just like to leave you with 4 key messages to take away. We will continue to grow in our traditional longer-term core market, and we believe that areas that we currently operate in will provide us with significant opportunities and more than enough to meet our ambitious growth targets. We'll protect our market position by leveraging retailer API integrations, which will make it very difficult for our competitors to dislodge us from existing retailer relationships that we hold. We'll also continue to improve our digital operational capacity to deliver economies of scale to maintain our profitability as we move forward. And finally, we will launch a digital Buy Now Pay Later product in the first half of next year. This will allow us to develop a consumer-facing brand and also ensure that we can meet all of the product needs of our existing retailers. So that simply leaves me to thank you for listening to me today, and I look forward to taking any questions that you may have at the end of the session. And next up, I'd like to introduce David Neal, who will speak to you today about our vehicle finance division.
Good morning. I'm David Neal, the Managing Director of our vehicle finance business. Kira Raisin, our Commercial Director, and I are going to outline why we are well positioned to win in a changing vehicle sales and finance market. Our core proposition, which leverages both our technology and credit breadth, is designed to help our introducers to sell more vehicles as simply and profitably as possible, and to support them with the sourcing and funding of their vehicles. To start, I'd like to give you a brief snapshot of where we've come from and where we're heading. STB entered the near-prime vehicle finance market in 2008, taking advantage of disruption caused by the credit crunch and leveraging our access to liquidity from consumer deposits. Following our success, others have entered the marketplace, and whilst the margins remain attractive, growth is constrained by the nature of the market, its niche nature. To seek profitable growth and to expand the relevance of our proposition, in 2018, the business embarked on a transformation program. The program scope was to re-platform the business to support future growth, to enter the prime finance sector, to extend our product range, and to launch an independent stock funding business. In 2019, we successfully launched our stock funding business under the brand V12 Vehicle Finance. This year, we launched our prime consumer finance proposition under the V12 Vehicle Finance brand, and will launch personal contract purchase, PCP, by the end of the year. Next year, we'll move our Moneyway near prime finance originations onto the new platform and unite our full rate for risk capability under the V12 Finance brand. So what is the size of the prize or the addressable market? Before the transformation programme, with purely near prime hire purchase, our total addressable market stood at approximately £1.3 billion of annual point of sale used car finance. Excluding the new car finance sector that is dominated by the manufacturer finance companies, following our transformation, we have now extended our reach into a market of £18.4 billion, which is evenly split between hire purchase and PCP. This slide illustrates in general how the market is organised in terms of sales and typically the credit profile of customers they attract. The blue bars represent the sellers of cars and finance. Broadly speaking, the newer the vehicle, the higher the credit quality, and conversely, where the customer journey starts with the ability to secure finance, the lower the credit quality. The grey bars represent the lenders and their main coverage. Predominantly, the larger lenders are focused on the higher credit quality end of the market, with lenders becoming more specialist or niche as the credit quality reduces. The green bar indicates how our product proposition extension allows us to address a wider market, and in doing so, more broadly address introducers' needs and what will become a single customer journey with full rate for risk and PCP. The last 5 years have seen significant change in the vehicle sales and finance market, and that is set to continue. There's been an increase in regulatory attention on the sector. This has improved practices, such as banning certain commission schemes, which, unlike others, we didn't participate in. The pandemic has forced dealers to look at their models and service their customers remotely. This, in turn, has given customers confidence to buy online, a trend that is likely to continue. The timing of disruptor models, such as Cinch and Kazoo, has been advantageous in them establishing their models. And finally, there is acceptance of and government's direction away from fossil fuels. Looking forward, in order to win, we will need to be able to support these changes, both in terms of technology and culture. Our programme does this. We have built the capability to underpin our future growth, and we have an established culture of innovation. Our API-driven architecture has enabled us from launch to support multiple channels, systems, and customer journeys, and will allow us to adapt and change at pace as these evolve. We have made the upfront investment, we've executed and are live with a significant proportion of our planned changes to maximise on the opportunity. To support our growth plans, we have launched our stock funding business, which is accelerating in success. We've launched our prime proposition and are seeing growth. We will shortly be adding PTP to our product range, and next year we'll have a full rate for risk through a single customer journey. To sustain, we've invested and are live with an AI-derived scorecard using the same decision engine as retail finance. Our new platform allows us to differentiate individual vehicles, which means we are EV ready, as these vehicles move into the used car running park. And early next year, we will move to a new collection platform, allowing us to support our customers more fully when they're in financial difficulty and more efficiently. In terms of care, as retailing changes, we're able to support all of our introducers with our API architecture, allowing us to expose the services they need to support their customer journeys. This is going to be of increasing importance in the future. We already have great examples of this, for example, in our stock funding business, which Kira will cover very shortly. And finally, not least of all, we will be one of only a very few, or maybe even the only lender with full rate for risk capability. Again, Kira will expand on this point. I'll now pass across to her to bring these aspects to life.
Thank you, David, and good morning, everyone. I'm Kira. As David's just said, I'm the Commercial Director for the Vehicle Finance business. Now, what David's just done is to describe to you the transformation that we've undertaken, the highly digital capability that we've developed, and how this enhanced capability is helping our dealers and our customers fulfil their ambitions. David's also shared with you a little bit more detail about that underlying transformation and capability that we've delivered. And that's to truly differentiate us in the market, not just for now, but also in the future. So where I'm going to pick up the story, I suppose it's a bit of a so what. What does this truly mean for dealers in the UK? So how I'm going to start is I'm probably going to put myself in your shoes. And if you were sat there or on the webcast at home listening to us, you might be thinking, are these guys really the real deal? Are they actually going to be able to truly differentiate themselves in the market? Are they special? Are they different? So the really simple answer to this is really good news. Yes, we are the real deal. We are very special and we are very different. But I didn't think you would let me just leave it there, so I am going to back this up for you with a bit of evidence. So I'm going to talk to you about three things. One, I'm going to talk to you about the proposition which we've developed, and how I'm going to do that is I'd like to talk to you about the UK dealer market and how diverse it is. The second thing I'm going to do, as David mentioned, is tell you about the success that we're already seeing with our first product that we've launched under our transformation. And lastly, I'm going to show you that if you take that UK dealer market with the compelling proposition that we developed and bring this all together, how the magic really happens. So I'm going to begin, as I say, with the UK dealer market. Now, quite often people will categorise that into franchised and independent. But at the core of our success is that recognising it is so much more multi-layered and multifaceted than that. And if you truly understand the layers underneath, you become a real expert in this market. So it might be as simple as, where is this dealer's business? Is it at an ex-petrol station forecourt at the side of a busy A road? Is it in a locked-up industrial unit where it's appointment only and fully online? What about the stock that the dealer chooses to put on his forecourt? How does he fund that? How does he price that? What sort of customers does he target? What does he think about finance? Does he use that just if a customer needs it to sell the vehicle, or is it a core finance income stream for his business? So what we have done is, by recognising all these differences and all these diversities of all these dealers, we understood that to create a compelling proposition that really met all those needs, one, it was going to be hard work, and two, it was going to take some brave decisions. So the first brave decision that we've taken is we've decided to be fully open in our API architecture. So what that means is we are system agnostic. We integrate with all of the finance and income platforms across the UK. So was that complex? Yes. Did that take a wee bit longer? Yes, it did. But was it worth it? Absolutely it was. What this means for dealers is we do not dictate to them who they partner with for finance and income. When they are looking at their lender panels for the following year, they might say, right, who do I want to go with? Well, we're on all the pick lists because we integrate with everybody. When the dealers are asking for recommendations from those finance and income partners, we receive referrals and recommendations from all of them. So it really was worth taking that extra time and decision. Secondly, and David mentioned this earlier, we've decided to be fully rate for risk. So what that means is we offer finance to a much broader range of customers than other typical lenders may choose to do. So we will help the customers at the top end of the credit spectrum with really low APRs to compete with the high street banks, but also if customers are slightly more credit impaired, if they're on lower incomes, if they've got checkered address history, we can also help those customers maybe with APRs as high as 29.9%. What other lenders choose to do is have a much narrower range of APRs, and they develop scorecards to match those customer profiles. Because we've got an AI-derived scorecard, because we've got the decisioning engine that retail finance use, because we integrate with multiple bureaus, and because we use soft search capability, that means we've been able to help this much broader range of customers. Let's see, where are we going next? This leads to us being able to help this much broader range of customers. So how I'll summarise is how this has been received in the market is our dealers think this is a breath of fresh air. It's so modern, it's so fresh, it's so slick. We speak their language, we understand and solve for their needs, we treat them as individuals, and we've developed commercial solutions to back all their business models. So simply put, we save them money, we make them money, we save them time, we take away all the hassle, and we give them peace of mind. So the second thing I wanted to share with you was the success of the very first product that we've brought to market. So this was launched a couple of years ago, and it's our V12 Vehicle Finance Stock Funding product. So we know that managing cash flow is essential for all businesses, but for the UK car dealer, where those peaks and troughs are so much more pronounced, managing cash flow can be a real challenge for them. So it's this exact challenge that creates the demand for stock funding. But what our dealers tell us is that the way we have developed and designed our product meets their needs in so many different ways than that name might suggest. So let me bring a few of them to life for you. Number one, we fund 100% of that hammer price, including the fees, the refurbishment and the VAT. What is standard in the market is to fund 80% of that vehicle value. The dealer has to put the other 20% in, and he also has to stump up the money for the fees. So not only do we help that dealer with his cash flow, but he also can start marketing and promoting that vehicle as soon as it's been purchased. He doesn't have to wait for it to get back to his dealership to complete that refurb himself. Second thing is we integrate with the majority of the UK auction houses. So whether that dealer chooses to bid in the showroom, to buy online or to use an app, we will pay for that stock as soon as he's purchased it. Again, what is standard in the market is the dealer pays for that stock and the funder refunds him up to 5 days later, which creates that short-term cash flow burden. And the last point is a really simple one, and it's a great example of something being so simple but quite transformational. So I don't know, does anybody in the room know what their vehicle VIN number is? It's a unique 17-character number that your vehicle was given when it was born or when it was manufactured. People don't talk in VIN numbers, they talk in vehicle registration numbers. The main platform in the UK to provide stock funding works on a VIN number. We've clearly chosen a different product, a platform. It works off the vehicle registration number, and every month it consolidates the fees, the interest and the charges into one simple monthly direct debit. The dealer feedback, and that of their accountants actually, is the ability to reconcile that monthly charge associated to each vehicle is so much more simple and transparent for them. So hopefully I've been able to show you there why we're being so successful. As David said, the success is just accelerating with this product. But maybe a picture speaks 1,000 words, and a video might do a bit better. So the next thing I'm going to show you is the app that we've developed with our partner Aston Barclay. They've got the app, and we are the only funder in that app. So if you want to buy stock on an app, this is the app that does it, and this is how we fund it. Just takes a minute. So if anybody was counting there, it was 3 clicks. He pressed the app 3 times to fund that stock with no outlay of cash from his business. So it really is very special. So if that isn't exciting enough, that was just the stock funding side of the business. I would now like to talk to you a little bit more about the consumer side of our business and when you bring this whole proposition together. So as I explained, if you have the UK dealer market and all their wants, needs and demands, and you match it up with our really compelling proposition, this is where the magic happens with these dealers. And what's great is it's inclusive for everybody, and this point of inclusivity is what really sets us apart. So whether it's the largest franchise dealers such as Peter Vardy, whether it's the largest supermarkets, Car Giant, Trade Centre Wales, whether it's the smallest medium and independent dealers or prestige dealers, there's something in that for everyone. So let me just tell you a little bit about these four dealers. So you've got Phantom Motor Company. Take a wee Google. You'll have Bentleys, Lamborghinis, Ferraris, some fantastic stock. He sells about 100 cars a month, and clearly they're above the typical average value of a UK car. So what he values about our proposition is two things. One, we're able to give him a commercial model with very low APRs to keep these vehicles slightly more affordable. And also he sells a lot on PCP. So Phantom are one of our launch dealers for the commencement of PCP by the end of the year. Then you've got Cheshire Motor Company. This is a really successful small independent dealer in Wigan. Sells about 65 cars a month, and what's really important to him is the breadth of our credit risk appetite. His customers, they view these cars as an essential purchase, maybe about £8,000, £9,000, and whether they've had those minor blips in credit, they've maybe got a lower income, they've maybe moved around quite a bit, he really appreciates that we can still help these customers with affordable payment, and that in turn helps him sell more cars. Moving on to V12, look at the size of that big warehouse. This is one of the largest independent dealers in the UK with multiple sites across the Midlands. They pride themselves on outstanding customer service and making the car buying experience fun and exciting. What they need from us is two things. One, it's our speed, so our automated decisioning in seconds for them. And secondly, is our fully online journey. We can send out the agreement to their customer with an e-link. They can check those agreements and e-sign at home. Their model is called Deal and Deliver. The customer does everything for home and they come in to pick up that vehicle. It's priced under market value and it's already prepped and ready to go, which is why they're one of the most successful dealer groups in the UK. And lastly, one of my favourites, you've got Bob Davies. Bob set this up in the 70s and it's now a second generation family business run by Matthew and Lisa. The backbone of their business is repeat customers. So they sell to local people and local families. And what Bob really values about us is our automated decisioning, but our digital affordability strategy. So what that means is we're able to make decisions about Bob's customer and whether he can afford these vehicles, afford the payments, and will he repay them. So if you think about it, when it's a family business and you know the people that you're selling your vehicle to, you don't want to ask them intrusive questions about their income, their expenditure, their bills, have you got any debt? We take care of all that for him and we say yes to his customers because we've already proven through the integrations with the Bureau and the digital strategy that the customers can afford these payments. So I could talk about these dealers all day long, as you might be able to tell, but what I would like you to take away from this is one thing. The fact that one proposition that's compelling and specialist, that's been developed by experts in the market, how it helps all of these dealers and customers fulfill their ambitions. The last point is the so what, the big so what. Does anyone remember what David shared as the size of the addressable market? So that was 18.4 billion. And the most exciting thing for me is we've just unlocked that whole market to our business in this really simple proposition that we've developed. And that's what gets us really excited. So that's it from me. I'm going to hand back to David. He's going to give you a wee bit of feedback from one of our customers and just share a summary around our ambitious growth from here. Thank you so much.
Brilliant, thanks, Kira. And hopefully that's brought our proposition to life. It's not a grey-haired man with PowerPoint. This is a real proposition that actually is working in the marketplace. Kira said I was going to give feedback from one of our introducers. Zuto is actually a tech-led disruptor. It's one of our biggest introducers on our near-prime business. Jim is the CEO of the business. And in this, what he's calling out is the importance of technology and strong credentials in that area to support his business. And he's calling us out as being first class in this area. And the second point he's calling out is actually we're going to help them move into the aggregator space, and we'll shortly be going live on some of the leading price comparison sites, which just shows kind of the shift in terms of how customers are actually going about seeking finance to buy their cars. We're seeking ambitious growth. As Kira said, we've opened up our addressable market, both in terms of our product and our credit reach. We've built some sound foundations that will simplify our operations and our collections, and ensure that we can support the move to EVs. Our APIs will allow us to help, not constrain our introducers as their models and use of technology evolves. And importantly, we'll do this by listening and continuing to listen to our customers, understanding their needs and helping them to achieve their ambitions. And in doing so, we'll strengthen our relationships. And finally, from me, there's really kind of nothing more certain than change. We can embrace changing consumer buying behaviour. We've invested in our future. We have a market that we can scale into. We have an open API architecture that supports multiple introducers, systems and customer journeys. And we have the opportunity for scale efficiencies. The winners in this marketplace are going to be the people who can embrace these changes and help their partners through it. We believe we're well placed to do this, and from that we can win. So thank you. I'll now pass across to John.
So first of all, good morning to all. I think in terms of getting out into the business, there are three particular points that I'd like to add to this slide. The first is that REF is actually the largest element of the SDB balance sheet within the loans and advances to customers. Secondly, the business was built in-house and has grown organically since, with a CAGR of 33% in lending balances since 2015. And that's through no acquisitions or purchase of third-party portfolios. Finally, the portfolio is predominantly in residential investment, professional landlords, which, when linked with conservative LTVs, attract one of the lowest and most favourable RWA weightings for a standardised bank. So what do we do? Well, our first legal charge is supported by professional valuations and both internal and external legal involvement with associated PI cover. Other securities, such as guarantees, deeds of rental assignment, debentures, charge over shares, are taken as appropriate. We do not rely solely on the value of the collateral. Serviceability is of equal importance. This is assessed not only for our exposure, but also a customer's wider portfolio and level of indebtedness. We equally consider exit routes as part of the initial underwrite, now whether that's through refinance, an amortization, or even the reliance on our security, to reflect both the upsides and potential downsides. Our customer due diligence takes full account of financial crime requirements, and that's recognising the high-value nature of the transactions, but we also obviously consider the reputational aspects too, ACCA, Panama, and of course, more recently, Pandora. Our policies and procedures are based on a through-the-cycle methodology. They've been proven to stand the test of time, and that's none so more evidenced through the economic impacts evident through the COVID-19 to date. Our overall portfolio against drawn commitments has an LTV of 58%, and that's remained stable over the last 3 years. The average advance is circa £5 to £10 million. On development facilities, they're on the book for circa 18 months, and on investment, typically 48 months. In terms of market dynamics, issues such as changes in taxation and wider market volatility has seen many smaller buy-to-let landlords exit the market. Conversely, there's been an increasing move by corporate landlords into the residential property market, whereas they were historically more attracted to commercial developments. Evidence of this? Well, Legal and General into build to rent. And in social housing, well, that's replacing a lot of the historic HMOs. We've seen M&G into the UK private rented sector, and Lloyds Bank intending to build in-house residential investment portfolio of 50,000 homes for rent by 2030, with an estimated portfolio value of 4 billion. The above are going to become major players in the residential space, and it's noteworthy of their ambition in context of the largest current listed landlord being Grainger plc, with an estimated portfolio of 2.1 billion. Most recently, in fact the last few weeks, we've seen Goldman Sachs announce their intention to purchase 700 family homes from Urban and Civic. So you might say, well, why residential? Well, I believe it's been seen to be more resilient over the, in terms of an asset class, simply because of the disruption caused by the pandemic versus what you've seen in commercial, and especially in the high street retail. So in terms of market structure, the UK market is huge. Annual new business volumes are circa 19.7 billion for development and circa 60 billion for investment. It's estimated that the UK BTL balances alone were circa 224.8 billion in 2020. Whilst huge, identifying which segments maintain the right risk-reward equation and adjusting risk appetite accordingly is paramount. The watchword is one of balance, and that's noting UK property, the sector, is cyclical. Capital values, of course, rise and fall, and whilst they have been benign, you have seen certain areas such as central London. In good times, lenders become assertive, and in search of volume, it features those typical drivers: falling yields and going up the risk curve. In time of downturn, falling capital values, economic stagnation result in cash flow issues and lead to distress, a factor evident for landlords and developers. So the obvious question is, well, where are the opportunities for SDB? Well, that's in that the high street banks favour focusing on existing customers. Buy-to-let, it remains attractive, but our focus remains on higher value, lower volume business, and that differs from a lot of traditional competitors who focus on lower values and higher volumes. And that latter point is in itself, they have to have scale in order to benefit from the cost income. The reduction in the activity of peer-to-peer operators is another opportunity. There are, however, headwinds facing all lenders and their customers. Environmental issues, flooding and energy-efficient housing are growing in importance. The regulator is taking a particular strong stance on the reporting activity of lenders. Cladding and fire risk. There is a partial remedy through the government in making support available, and some of the larger developers are offering to rectify defects, but I think the likelihood is that cladding and associated issues will be around for years. And whilst the initial pain is probably with owner-occupiers and landlords, unless a fully satisfactory outcome is achieved, lenders who perhaps have not been as diligent as they might have been can expect to see the value of collateral impacted. Building regulation and controls will undoubtedly have to change, and that's got a potential impact to not only increase the cost of developments, but also need for further investment on remediation to improvements in housing stock, something for our new corporate entrants to think on. A lot of recruits into the REF business have backgrounds with high street banks. We benefit from the training and development given by those banks over the years, which is of high quality. Recruits are very often surprised to see their old clients, whilst they were at the high street banks, are also our customers too. We actually sit comfortably alongside the high street banks, but where we can be more agile in dealing with customer requests. So the obvious question is, why and how does STB compete? Well, feedback from customers and intermediaries highlights our structuring capabilities, whether that be things like selective amortizing profiles, through to workout capabilities. These are top-down skills of our people, and it is our people. We're known for delivering on our promises, confidence in our execution capability, being reliable and offering certainty post credit-backed heads of terms. These are important things that people tell us we deliver. I think this is reflected in the following customer testimonials. And so a practical illustration of what our origination initiatives look like. The green loan is just a current example. It's a practical example of being proactive and agile, doing something rather than talking about what could, might, or ought to be done. Our approach was based on the environmental need for all new homes to be carbon neutral by 2050, and acting as a positive contributor in the banking sector to drive customer behaviour, helping to deliver the UK government's 2035 target of all homes reaching an EPC rating of C. There's been a lot of interest, as can be seen from the level of referrals and business written. That's a good outcome to our customers, STB, and the future. Whilst the dynamic of demand outstripping supply remains a feature in the availability of UK residential housing, the opportunity remains to grow the REF business. There is the opportunity to double the size of the business in the long term in support of our customers, because Britain needs more new houses, at least 100,000 new homes per annum, and supporting professional landlords, improving the quality and productivity of their portfolios through effective asset management. As a summary of this session, I'd like to leave you with these key points, but with the emphasis that in all of these aspects, they are fundamentally underpinned by the experience and quality of our people. And now I'd like to hand over to John Bevan.
Thank you, John. Good morning, everybody. My name is John Bevan. I head up the commercial finance business in Secure Trust Bank. I'm never sure whether it's after or in spite of 38 years in the banking and asset-based lending sector, I'm very conscious that our product probably isn't as familiar to many of you in this room as some of those that you've heard my colleagues talk about this morning. In very simple terms, we're an asset-based lender. As the strapline on David's earlier slide suggests, we simply provide working capital solutions for UK SMEs with the benefit of asset-backed security. Our facilities range from 1 to 50 million, and to help demonstrate this, on screen we have one of our clients, the Lakes Distillery. As the name suggests, they're based in the Lake District and produce gin, vodka, and my particular favourite, whiskey. In the case of whiskey, the stock can be stored for 10 to 15 years, and it has a minimum gestation period of 3 years before it can even be determined or classified as being a whiskey. This, in effect, ties up vital working capital for the company, and this is essential for the ongoing production of new stock lines. In simple terms, we take a legal charge over the assets on the balance sheet, and in this case, they're debtors, plant and machinery, and importantly, the inventory itself. Noting that the inventory in this particular case, being the whiskey, should appreciate in value over time, we're able to release essential funding against these assets and enable the company to continue production of new products. So, in terms of our structure, the commercial finance book, as you can see here, represents 1/2 of the SME business, along with John's real estate finance team. We currently, though, represent just 10% of STB's balance sheet. We commenced trading from a greenfield site in August 2014, and it was a key strategic decision of the business to build a robust infrastructure with all future growth being based on this. While some of the growth has inevitably been affected by COVID, we will be able to demonstrate that we have outperformed the market and taken market share from our competitors. In simple terms, with 3 main product lines, or assets against which we lend: inventory, receivables, and post-COVID, the introduction of the government loan schemes. We will lend against some commercial property, but this would ordinarily be to create headroom, or as we call it, boot collateral. The government loan schemes are restricted to the distribution of the CL bills, Coronavirus Large Business Interruption Loan Scheme, and CBILS, CBILS being the junior partner of that product. And the successor to both these schemes has been the Recovery Loan Scheme. We actually declined to administer the bounce back loans on the basis that we felt the application process was not, in our view, robust and would not be of benefit to our existing client base. All of the facilities we've written have been used to support our existing clients, and to date we have 0 defaults and 25% of the loans we've written have already been repaid. All that said, our primary product remains advancing against debtors. Prior to COVID, nearly 90% of our book was against debtor exposure, and as you can see on screen, this is now down to 60% with the advent of the application of government loans. It's important to note that in most cases, we will therefore look through our client to the debtor to understand who our counterparty risk is, but more of that to come. So what do we actually do? Well, this is a market dominated by the high street banks. They have over 2/3 market share and benefit greatly from lower cost of monies and beneficial capital weightings under Basel. Outside of the high street banks, there are more than 50 independent providers of various forms of ABL. The UK remains the most developed market for asset-based lending outside of the US. Our operating model as we can see here on the left-hand side, relies heavily on the origination and portfolio of owning the risk. Key to the effectiveness of this model is the level of collaboration amongst the three areas. We believe that this is both cultural and essential to how we manage our clients. Over the last 7 years of trading, our risk impairments have totaled 0.07% of total monies advanced. This is significantly lower than you would ordinarily expect to see in this market, but more importantly, it tells us that the collaboration in our model is being effective. Unlike the high street banks, we do not have a captive market of potential clients. Our core channels, as we can see here, are the accountants and the professional advisory community, being the corporate finance boutiques, etc. But most importantly, over half of our business comes from private equity. They provide us with our greatest source of new business. Interestingly, we do not use brokers. PE is highly important for a number of reasons. They have deep pockets and are typically very supportive of their own investments. They have repeat transactions, and we obtain multiple introductions from the same source. They tend to be more service-led rather than price sensitive, i.e. they value service and relationship over cost. Key strategically to our development over the last 7 years has been the build-out of our regional model. Our head office is in Manchester, and with further regional offices in Leeds, Birmingham and London. It's essential that we are close to both our introducers of new business and our clients. Both of these are built on our relationships. In terms of proven track record, in 2020, pre the pandemic, this was a £21 billion industry with 40,000 businesses using these types of facilities and supported by a history of double-digit growth. From a start-up, we have already become a top 10 provider of ABL facilities, as we can see here, outside of those high street banks. COVID had an impact on the industry, inevitably, and on our own book. We've seen excessive levels of government liquidity, which have seen typically the clients drawing a third less of the funds that have been made available to them. As at June 21, the market continued to see its balance sheet operating at sub 14 billion, so down a third. Against this, our own book has fully recovered and continues to grow, with lending balances now well ahead of pre-pandemic levels. I won't go through all of these, but there's significant opportunities for further growth for us. Asset-based lending facilities do not amortise like traditional debt. Our facilities are evolving in nature. The working capital we provide should help the businesses to grow. This growth may even generate a need for additional working capital, and we often see our facilities grow in line with our clients' individual growth. For this reason, the product is often referred to as sales-linked finance. Many of our clients will go through various in-life transactions, all of which we believe we're best placed to fund. So far, our average client life stands at 6 years, but then we have only been trading 7 years, so we're still calculating this stat. This creates an endowment effect in the book, and to demonstrate this, in the first 4 months of trading, we put 4 clients on between August and December 2014. These 4 clients in those 4 months generated £120,000 worth of income. I'm delighted to say that those 4 clients remain in our books today and have made a contribution to us of 1.4 million. We have written a total of 16.7 million of new business since our inception and through to June 2021. This has so far generated revenue lines of 60 million. New products and product flexibility, well, we're not naive enough to believe that we can reinvent the product. But there are areas in the market today where we currently don't have a high exposure, but we are comfortable that we can exploit these. Participating in the syndication market, which is a growing sector for our industry, is a clear example of this. In short, in line with our strong historic growth rates, we still believe that there are excellent opportunities for the CF business to continue growing market share and increasing its contribution to Secure Trust Bank. Our people, well, you've heard from each of us today, our people make the difference. Attracting and retaining the best people is no different to us as well, and is key to us delivering our core values. We've already experienced high double-digit growth, with over 2.8 billion of invoices now funded annually, compared to just 1.7 billion 2 years ago. The average facility size is now 7.5 million per transaction, compared to just 2.3 million 3 years ago. All these factors are helping build on the endowment value I previously referenced. The credit process is not an automated approach, and it relies heavily on the depth of experience we have across our business. Our performance of 0.07 impairments reflects the quality of credit controls we have in place, but also these need to be applied in a commercial but disciplined manner. So, ensuring that our people are fully engaged in the business is essential. We take feedback from our employees extremely seriously, and the most recent staff survey showed a 98% engagement level and 100% trust of senior management. Ensuring that consistency across 4 offices has been our biggest challenge, and this has been supported by a senior management team with over 200 years industry experience and a focus on ensuring we put the customer at the centre of everything we do. On screen is one of our existing clients, PE house well known to us called Ilagmo. We fund 3 of their existing transactions who were looking to purchase Orchard House. This was a US corporate carve-out where they were looking to exit the European markets. We provided a full debt structure to Ilagmo to assist with the acquisition and, importantly, the subsequent provision of ongoing working capital. Within 12 months, we'd refinanced the facility to dilute the PE loan accounts and allow Agmore to take cash off the table. The business has since trebled its EBITDA, and we're now well positioned to fund any future acquisitions or sales to market. This is a demonstration of how we can provide ongoing in-life solutions to our clients and retain the relationship as the business grows or even changes its status. So what's the opportunity? Well, so far from a growth perspective, we have a business with excellent momentum, a strong market position and a developed infrastructure. It will be important we take advantage of the opportunities that are available to us and continue to move up the food chain in terms of deal size and value. Sustain, well, we build out our regional model with the best people. We will continue to focus on the PE market. That's extremely important to us, and broadening this introducer base is a primary objective. Our existing model, we believe, is now proven, and we know it delivers. From a care perspective, our customers remain at the centre of everything we do, as we've said already. But we must ensure that the trust and engagement of our people remains at the existing exceptional levels. So, in summary, we are protective of our reputation in the market with our clients and with our employees. We have a first-class team of highly engaged and experienced people with trust in the senior management team. We will continue to put our clients at the centre of everything we do, maximising our ability to be both commercial but with an excellent credit stewardship. We must retain and maximise our agility to exploit the competition's weaknesses. And lastly, the book carries an endowment value which provides momentum and certainty for future growth. Thank you for your time. I look forward to taking any questions at the end. I understand we will now take a 10-minute comfort break. Thank you.
So you've just heard all of the exciting opportunities we have in our diverse and specialist businesses to drive towards our growth ambitions. But of course we need to fund this, and we need to fund this growth in an efficient and sustainable way. So in the next few slides, I'll just talk to you about our approach to funding and capital. So firstly, we have a structurally robust balance sheet, which is highly matched and behaviourally funded long. This provides us with a prudent base to fund our lending ambitions. As you can see, our funding approach and profile is focused on retail deposits with a small amount of wholesale funding provided through the TFSME scheme. This therefore gives us additional further capacity to access cost-effective collateralised funding in the near to longer term. You can see the average residual duration from a contractual and a behavioural point of view for both our assets and liabilities on the right-hand side of this slide. With the recent sale of the consumer mortgage portfolio, the contractual duration is materially matched and the behavioural duration is funded long. This will remain our core strategy. We've taken action to evolve our funding mix over the last 3 years, from a predominantly term-funded strategy to a more diverse product and duration strategy. We've introduced a range of ISA products, short-duration notice accounts and access products, and we have transformed our cost of funding from 2% in 2018 to 1.4% in the half year. This makes us much more competitive in our lending markets. Our longer term strategy is to continue to diversify our product range and to increase our mix in ISAs and in the short-term notice accounts. These organic growth plans require a considerable uplift in our deposits in the medium term, and to support this ambition in an efficient and sustainable way, we will be investing in our savings digital capability in 2022. This investment will be in the upfront, front-end customer journey with the development of device-agnostic, mobile-first onboarding and servicing capabilities. This will transform the number and proportion of applications submitted on digital channels and automate 85% of the processes in the longer term. This will support an increase in the proportion of the savings market that we serve and help improve the customer experience and leverage the cost base. So from a funding perspective, to summarise, our match funding approach, further product diversification, unutilised capacity in collateralised funding, and planned investment in digitising the customer journey provides us with a platform to support our lending but growth ambitions and the bank's net interest margin. Lastly, on to capital. As you can see from this slide, the bank has managed to conserve capital through the pandemic and has emerged in a strong position. CET1 capital ratio stood at 14.2% at the end of June, and you can see we have significant headroom to regulatory minimums in both CET1 and total capital. Also, our capital is held in CET1 and Tier 2, and we therefore have the opportunity to further optimise the stack with AT1 in the future. This strong base allows us to fund the lending ambition and provide sustainable dividend to the shareholders. Thank you, and I'll now pass back to David, who will provide us some closing remarks.
Okay, thank you, Rachel, and thanks to Rachel and all our presenters actually. I mean, You know, we know internally we've got a great team, great people, and I thought they've done a perfect job today bringing to life their diverse business units, so thank you. I just want to go back briefly to the slide that I showed earlier of why I believe Secure Trust is such an attractive investment proposition. Listening to the presentations today, you'll have been struck by the expertise of the team and deep specialist knowledge, and that exists across the group. You've also heard our strong technology and digital capabilities have made it easier for our business partners and our customers to deal with us. What most jumps out, though, clearly and consistently, is that we understand our markets and have the capabilities to deliver on our growth ambitions in each of these markets. The journey to build the most trusted specialist lender in the UK is certainly going to be an exciting one. We've been confident enough earlier this year to share our plans and disclose our medium-term commitments, and the introduction of our new lending book target further demonstrates the confidence we have in that plan. We will deliver lending book CAGR of 15% plus. Of course, we acknowledge that we may not always deliver 15% growth in every year. And you know that in the first 9 months of this year, we delivered 7% growth despite the national lockdown in Q1. That means we will have periods of time when we deliver more than 15% growth, and we remain very comfortable with that. Where does that confidence come from? Well, you've heard from the team today the many opportunities that exist across these diverse specialist business units. That's why we are so confident in delivering against all our commitments. I've summarised on the slide, though, just pulling out from some of the presentations, some of the breadth of key initiatives across the business units that are worth referencing again. The launch of a digital buy now, pay later capability early next year in retail finance. The extension into PCP products in vehicle finance. In real estate finance, the team's strong track record, market growth, and the ability to be innovative and grab opportunities like the Green Loan Scheme will stand us in good stead. And participation that John mentioned in commercial finance in larger syndication transactions. Not to mention what Rachel touched on, our intention to enhance the digital capability for deposit gathering and servicing those accounts. The momentum that has been building this year gives us a perfect platform to build towards that growth ambition. And just to conclude, some key messages I really want to leave you with today. Our diversification is a key differentiator. We have a diverse mix of businesses that allow us to respond to evolving market conditions and provide us options in how we manage the portfolio. We have a heritage in specialist lending, and our people have a deep understanding of the markets and their customers, and you heard that ably described today. We have the necessary credit and underwriting experience to assess customers thoroughly in their ability to repay and afford their debts, and to prudently manage our exposures as we help more customers fulfil their ambitions. And we have invested in technology and digital capabilities, and these have helped us to differentiate, to compete and to win. We plan further digital enhancements as we've covered, and these will continue to improve the customer experience of dealing with us and also allow us to become more cost effective. We have a strong track record and the necessary expertise in the team to really grasp all of these opportunities ahead of us. As a result, we're extremely confident in the delivery of the ambitious plan we set out for you today and all the medium-term targets being delivered. With that, I'd just like to take a moment and then open up to questions, and the intention would be to start with those of you who are gathered in the room. Dawn does have a mic, so if you do want to ask a question, please stick your hand up. Portia.
Thank you. Portia Patel from Canaccord. Thank you for the presentation. I've got two questions, please. First one is on the digital buy now, pay later. Just wanted to understand if that will be an FCA authorised product from the outset, and if you could just remind us what the points of difference between an authorised product and the current unauthorised offerings on the market are, that would be very helpful. And secondly, just with regard to the spend outlined for the investment savings platform, just if you could provide an indication of quantum and whether that's already captured within current budgets or is additive to it. Thank you.
Thanks, Portia. We'll cover the buy now, pay later questions first, and I'll just tee up Rachel to have a think about a response to the digital savings in a second. Listen, just for clarity, listen, we're a fully regulated entity. Our intent when we launch a digital buy now, pay later capability is it will be fully regulated full affordability assessments of the customer, full credit check. You wouldn't expect anything else from us, but that will be the case. Nick, I don't know if you want to comment on the differences between regulated and unregulated short term.
No, I think most of it is on the lender's side. So I think from the consumer point of view, they won't notice a huge amount of difference in the product. It's the way that we, certainly around the affordability piece, is probably the biggest difference.
I mean, what is unregulated today, Portia, is basically there's always been this carve out for any 0% interest that's less than 12 months has been carved out and is not regulated. So that's the difference. And that's what's looking to be captured in the new regulation, and the consultation came out last week. So an expectation probably the back end of 2022, those rules would be tightened up to capture more providers. But we're already fully regulated. And Rachel?
And in terms of the cost, if I recall it correctly, I think there's about £1 million of upfront cost that we need to actually develop it, and then there's obviously the ongoing cost of it. We've got James in the room somewhere who's looking after savings. And in terms of whether or not that's in the numbers, yes, it's budgeted for, has been budgeted for a number, well, since the beginning of this year.
Great. Thank you. Gary? We'll just wait for the mic, Gary.
Thanks. It's Gary Greenwood at Shore Capital. I've got two questions, if I can. The first is on buy now, pay later. I think you said you had 1,400 retail customers or thereabouts at the moment. I was just wondering how many of those you think would be appropriate for a buy now, pay later type product, and how many of those that are already have one from a competitor. And then secondly, on vehicle finance, you talked about bringing the Moneyway brand together with the V12 brand, I think, next year. Presumably there'll be cost savings from bringing those two platforms together. So if you could just talk about what the potential savings are there, that'd be great. Okay. Thank you.
On the first point, Nick?
Yes, so our existing retailer base, it's in excess of 1,400 different retailers today. If I go back to the sector view that we have, which they're all spread across, we've looked at each of those sectors, and we think that to greater or less degrees, buy now, pay later is relevant to all of them. So some of them are slightly more advanced with existing offers. We haven't taken a straw poll, but I would suggest that probably about half of the retailers that we talk to, certainly the larger ones, have offered some sort of buy now, pay later product. But I think what I would say to that is that they're all still trying to find a way to hold it into their proposition. They haven't quite cracked it. The example I used around the fashion market, so that's where that product grew. That's where it's very prevalent. It's very noteworthy that market doesn't have existing fixed term credit offers. So where retailers are struggling is where they put these two things together. So even in areas where retailers have tried it, not many of them are telling us that they've sort of come to their ideal proposition going forward. But looking out, we think that the sector approach, there isn't any of the sectors that we operate in where we looked at it and thought, well, hang on, bail-up is just not going to work there. It'll work in all of them to some degree.
I think the other thing important to remember is not just the 1,400 retailers that I mentioned, but Nick's point about the 840,000 existing consumers who also we can talk to directly about the proposition as well. Okay. And then on vehicle finance, do you want to pick up on the removal of two systems?
Yes, so as we move to originating on one platform, it will mean that actually all the investments we need to make in terms of the customer journey, our scoring, the processes, actually we're only investing in one platform. So going forward, there's a opportunity for saving there. But it also allows us to create economies of scale. So as we scale the business, that's when I'd see us being able to leverage the benefits of the investment we've got. But it's got to come with the growth to achieve that.
Thank you. Ed, we'll just wait for the mic. Yeah.
Great, thanks very much. It's Ed Firth from KBW. I guess one of the things we're all thinking about at the moment is it looks like we're going to be entering a period of rising interest rate environment, which is something we haven't really seen for, well, I guess, for a long time. I just wondered how you, I mean, I guess in all your businesses, how you're thinking about that in terms, and I'm thinking particularly things like real estate. There's obviously a lot of question marks about how sustainable some of the growth we've seen there is, and how you're thinking about that either in terms of volumes or credit. And then also, I guess, Rachel, from a balance sheet perspective, is there some sort of mathematical number that you can give us in terms of, I don't know, 1% does X million or whatever to your NII? I know that's all a bit artificial, but it would be interesting to know roughly how that plays out. Thanks very much.
Okay. John Bowers, do you want to pick up on the considerations for rising rates for your business?
Sure. So I think you're absolutely right. Yes, we are expecting interest rates to increase. What I don't think will happen is that a lot of maturing facilities with some of our competitors, they'll still be looking to refinance, and we certainly won't be reducing our pricing. We price for the risk. So look, yes, I think the rising interest rates are inevitable. Will it have a real impact? Yes, it probably will on some types of facilities, some types of customers, but I don't think that refinance thing will go away. You know, people are going to have to pay whatever the going rate is to get it refinanced. And as I say, we won't be following the market downwards in order to capture it. We believe we're in the right place in that thinking.
Thanks, John.
Yeah, in terms of the balance sheet, obviously most banks, as everybody in this room will know, that a rising rate environment is usually good for us. In terms of our balance sheet, I've got Pete in the room at the back, our group treasurer, so he'll probably know the numbers better than I will. But we obviously have a balance sheet that is funded long, so we're sitting in a good position from a behavioural point of view. If I recall correctly, Pete, you have to correct me if I'm wrong. NII sensitivity is around 3 million.
No, the latest published 100 basis point shock would be about 1 million.
Ah, sorry.
Over a full year.
Okay. Thanks. Yes, Ed, come back. Yeah.
Thanks. No, I was also thinking about things like interest-free credit. I mean, I guess that is something which is much more expensive in a higher rate environment. I don't know how that filters through either in terms of your customers. I guess it's the retailers who are paying that, but how you might be thinking about how the margins in that business may alter over time.
Yeah, so the model with interest-free credit, as you say, is the retailers would effectively pay the cost. Unfortunately, I'm old enough to remember interest rates going up and down on a regular basis. So along with the rest of my team, we've worked in that environment, and some of the retailer agreements that we have actually have linked price increases, more because they want clarity of what that will cost them. So even though it's not in the recent history, there is a tried and tested methodology for increasing pricing. The other thing to note is within retail itself, obviously margins are significantly bigger than in financial services. So the change in interest rates doesn't materially affect the retailers until it gets into very large numbers, which I don't think we're expecting necessarily. But from a practical point of view, there are triggers within a lot of our agreements where we would move the price simply on whatever the base rate or equivalent was in the market.
Thanks, Nick. Any other questions in the room? Yeah, Pedro.
Hi, Pedro Fonseca, Edison. I'd like to know a bit more about new products in the motor finance that you might be targeting 2022.
So what product?
The new lending.
Yeah. So the main product that we'll be bringing to market literally in the next couple of weeks in terms of testing is PCP. So in terms of customer products, having PCPs core, the FLA used car market has roughly, in terms of value, 50% of used cars financed on PCP. We're not thinking that will probably be quite as extensive on our business, just because of the age of cars that we'll probably be financing, but it's key to the overall proposition. I think our ability, and Kira shared examples of that, I think our ability to leverage our technology to make it easy for dealers is a key part. So there's customer products, but there's a proposition for the dealers. And I think what we've designed enables us to support dealers with their different journeys, and particularly as they move more online. I think that's going to be an increasing trend. We can support them as they do that, and yet we still have a single customer journey, which I think is probably one of the points Nick made early on in his presentation, that having these APIs allows flexibility in terms of the customer journey and the people that we get the business introduced from. But when it comes to us in a consistent format that allows us to auto-score and come back automatically with the decisions.
Hi, it's Ashley Thomas from Schroders. Just two questions. Firstly, on the cost to income target, sort of getting that down, but broadly, sort of how much of that is being driven by the business getting bigger, the lending growth targets, and what element will come from the increase in digital capability?
Yeah.
And then secondly, on retail finance, just as a consumer, obviously in the past I've experienced V12 very happily, but I've also experienced ICA through Vitality. I don't know whether they're sort of increasing in terms of market presence at all, or I think they've also got a buy now, pay later proposition. So I don't know whether they've come onto your radar. It doesn't look, from Nick's expression, doesn't look like they have, but certainly through, they finance my Apple Watch through Vitality.
Yeah. So I mean, I think there's been quite a number of buy now, pay later style products come to the market. Sometimes it's quite hard to track all of them. But yeah, we've been watching the market for some time in that particular space, and we think now is the right time to move on it. But we will approach it from a different perspective. So all of these new startup entrants typically are coming from a blank piece of paper basis, and what I think they lack, that I believe that we have, is not just the retailer relationships, but the knowledge of working with the retailers on a very broad basis. But that particular example doesn't immediately ring a bell with me.
And on the cost-income ratio, you're right. I mean, listen, the growth ambitions driving the top line is having a major impact on that. I mean, the one thing I would remind everyone is that if you go back 3-4 years, the business had a cost-income ratio below 50%. The reality is our costs have been growing faster than our income for 3-4 years, and that's what we're going to stop and reverse. We don't have in scale relative to others, we don't have a cost base of billions. I can't remember the exact number at the end of 2020, but little around the 100 million mark run rate, a bit more. So the key thing is, how do we just get operational leverage as we scale up the businesses and keep that efficiency coming through? And digital becomes a key part of that. I mean, half our costs are really people, and a lot of that in operational areas. So clearly, the more that we can make the journey easier for customers and drive further efficiencies, there will be a benefit there. But the top line growth is really a key part of it. Okay. Any others in the room? I do have an iPad in front of me to take. There's about 50 people logged in online. So I do have an iPad here, which I'm assuming questions would pop up automatically if they asked any. But currently we've got no response from the juries on the line. Ed.
Thanks so much. I've always got questions, so I might as well keep going. I guess two questions. One was about the motor finance business. We're obviously facing a huge transformation in that industry over the next, I guess it's not in your plan period, but it's over the next 10 or 15 years. And I'm just wondering how that's coming through in terms of your thinking, used car prices, terms of finance. Are you thinking about shortening the term, diesels versus electric? All of that seems to me to be a massive headache, and I don't know how one really should be thinking about that. So that would be interesting. And I've got a second question, which is, I guess across all the divisions, one of the things that comes through is your sort of customer focus, and one of your competitive advantages is you seem to be able to offer more bespoke offerings in terms of pricing, etc. At what point, in terms of scale and size, does that start to restrict your growth? Because I guess the reasons the big banks can't do that is because they're so huge, they've just got to offer a standard thing. So is there a limit at some point where you have to start standardising things and perhaps lose some of that competitive advantage? Thanks.
Okay. Vehicle finance first, David?
Yeah, so in terms of the move in terms of vehicles, it's something that's kind of constantly on our mind, actually. So making sure that we're financing the right vehicles and have the right assets on the balance sheets key. And yeah, that can be managed in a new platform. We can be very specific on models and derivatives, so we can decide which vehicles we want to include or exclude, and we can do that automatically. We can pick that up from the registration number and know what classification of vehicle that is and the Euro emissions that comes with that car. But in simple terms, you can also determine that by the age of the vehicle that you take on when you finance. So I think at the moment we don't finance anything that's below Euro 5, for example. So there's, yeah, we do that by way of the age of the vehicle. In terms of EVs, we just really primarily see these as vehicles. I think some of the earlier EVs are maybe things we'd maybe want to avoid, in that some of them haven't had the kind of the battery life that was expected, but the technology's moved on absolutely at pace. For us, probably the challenge of financing them is waiting for them that stock of really good vehicles to start coming through as used cars, because generally a new car's with its first owner for 3 years. So it's going to be a few years before there's absolute volume for us to be able to support in terms of our products. And we're going to have to consider quite carefully where we sit on things like guaranteed future values. The manufacturers are offering quite long guarantees on the cars now, some of them up to 10 years and 8 years on battery life. So understanding specifics on the models will influence, I think, our strategy as that starts to mature in terms of used cars.
But is there a sort of do you feel any pressure at this stage to do things like not financing diesel cars? You know, I mean, we see a lot of pressure on the banks about not financing coal power stations, etc. So even though commercially it may make sense to finance a, I don't know, diesel Land Rover or something, do you feel sort of pressures in terms of ESG targets to say, well, actually, if we're going to get to net neutral or whatever, we perhaps shouldn't be doing that?
Yeah, I'll pick up if you like, David. Listen, we've had a very good piece of work done recently, led by Chris, CRO, looking at all of these potential pressures that might come along, Ed. And we had a good conversation at the board back end of September. There is a pretty clear risk appetite we've got internally for climate and the implications. You're right, it's the vehicle finance and the REF business in particular that are impacts. And we've actually defined some triggers and limits that we'll closely monitor the type of assets that we're underwriting. And obviously initiatives like John's green loan proposition will help with that. So we'll keep a close eye on that. At this stage, we're not at a position where we've made a commitment to when you get to a net zero and when you maybe don't start underwriting certain assets. But that's a next phase of work. And I know there was even an expectation announced this morning out of COP26 about firms being required to set their target to get to net zero. So that's something we'll take on board, feed into our thinking, and at the appropriate point, once we understand it fully and the implications for our business, I suspect we'll all be required to announce when we're expecting to get to net zero. Yeah. On your second point about when do you get to... Listen, I don't think in our consumer businesses, given how highly automated it is, there is a restriction on how we operate there. I mean, I think what you're calling out really is in the business finance segments, which are very specialist, manually underwritten, really, the core underwriting capabilities of the team, really important to consider. If you do the math and work back from our balances in those businesses to the number of customers we've got, it's not a lot. Clearly, we're at the higher value end, lower volume end in those businesses. I think what John Bevan was touching on is there may be opportunities for us to think about, now there are new technologies and new data sources available, are there certain parts of that asset-based lending market that you could potentially move into because it becomes highly more automated and it isn't suited to our existing model. So so I don't think there's restrictions on consumer. There might even be opportunities on the business finance side to drive digital and data into the process more fully than it is today. And as you'd expect, these are things we are looking at. I don't know, John, if there's anything you want to add to that?
No, I mean, absolutely. As you say, I kind of alluded to it earlier. The high street banks the IT systems they have are quite prohibitive. Trying to get compatibility for the high streets to new technology is a major challenge for them, whereas we can adapt to that quite quickly. We're already trialling some software, and that improves. It's not just the speed with which we can get that data, it improves the integrity of the data as well. So there's significant upside for us.
Thank you. Hi, it's Justin Bates at Canaccord. Just a quick question. You've got two significant products launching in Buy Now, Pay Later and PCP. How should we think about the next 12, 24 months in terms of growth from those respective businesses? Not asking you to put a number on it, but would you expect in absolute terms the growth to be stronger from PCP?
Well, listen, as you know, we're not breaking down across, the business units, that sort of 15% plus sort of medium-term target at this stage. But clearly, these are the initiatives that have given us the confidence to set that 15% plus target. So, it is embedded in our plans. So we've had line of sight of these for a period of time. We've just had the opportunity today really to bring them to life and share them with you. So, they are important parts within the different respective businesses that are already embedded in that plan to get the 15% growth rate.
Okay, thank you.
I do have, sorry, Pedro, can you go?
With so many, all the divisions poised for a lot of growth, and with your capital base being good but not, and what do you call it, not perpetual, could you give us some color on how the debate and decision making regarding capital allocation among the businesses, particularly as people put in budgets, set targets, and how is it done in terms of scheduling and debate, et cetera, et cetera?
Yeah. Planning process?
Yeah, I mean, obviously we have a planning process. We're in the middle of planning right now, and we are looking at the group as a whole, but we have budgets that are provided to us by all of our divisions in terms of their capability and capacity to do stuff. We then obviously consolidate that and take a look at it from a capital perspective and make sure that we balance the books in terms of getting the return that we need. So it is a collaborative planning process that is bottom up, and then we take a look at it from a group perspective.
Hi, it's Ian Gordon from Investec. Can I just ask for some comments on risk appetite? And I'm thinking particularly of the retail segment. Sort of in general terms, you, like all banks, made macroeconomic assumptions early on in the lockdown crisis, which were much more prudent than the consensus view of the world today. And certainly previous senior management articulated a very cautious lending appetite, zero appetite for lending to people on furlough, for example. Two questions, really. Firstly, do you feel like you were too cautious and left some cash on the table? And then secondly, going forward, as you move into new product areas, buy now, pay later, areas where we probably don't have a real handle yet on the on loan loss charging assumptions, do you regard yourselves as taking any repositioning of your credit appetite? And do you have any sort of very general thoughts you can share about loan loss rates or normalised impairment rates in your new product areas?
Yeah. Listen, I mean, just to go back to the broader point, well, I mean, Rachel will come on to the MES assumptions in a moment, but in terms of the broader point, I mean, I made quite a clear distinction when we were at I think it was the full year results or the interim results. And, quite rightly, through the pandemic, the business was quite focused on minimising risk, and we took a different approach in different businesses, to do so quite appropriately. But our job is actually to manage risk and reward. So there were parts of our business last year where we tightened up very tightly. All of those have now been back to a pre-pandemic position. Listen, the reason we've been quite keen to set a new strategy, a new core purpose, for me, if your core purpose is to help more businesses and consumers fulfil their ambitions, you have to be quite careful about staying true to that, not closing for business completely in certain business lines. So I would like to think if we ever faced a stress like we had previously, there might be opportunities to be more surgical about where we apply some of the tightening. So that would just be a general point to make. I think in terms of the PCP and buy now, pay later, there is lots of market data about performance of others and their experience. So, Nick can, probably share the data, but on buy now, pay later, digital, the newer propositions, we've had a chance to look at what the experiences of some of these fintech providers in different markets across the world, where they've become a bit more mature. So Australia in particular, Sweden and other. So we're sort of building in some of the informed data from those types of experience, which are 3-4 years down the line from where we're going into our models for loss rates. But the one thing we just want to call out again is that over the last 3-4 years, the business has done a very good job of improving the credit quality of the business that we underwrite. I mean, the reality is, as Nick mentioned earlier, 70-odd%, 75% of business on retail finance is 0%. I've spent 20-odd years running and building credit cards and unsecured loan portfolios. The lower the price, the better quality you attract. And those people who are less confident about being accepted opt out. So this has been a real shift that we've delivered over the last 2-3 years to improve the credit quality of the book. I don't know, Nick, if you want to recall the loss rate or something.
Yeah, so, I mean, buy now, pay later, in essence, is a 4-month interest-free loan. That's pretty much what it was. The delivery mechanism is what's made it a little bit special, and I think that accessibility by consumers is what's made it such a prominent product today. So the way that we look at it is that we have an enormous amount of experience in interest-free lending and very detailed experience in loss rates. So when you extrapolate that out for a 4-month loan, what we're hearing in the market is it's a very similar profile of customer. We certainly won't be changing our risk appetite for buy now, pay later customers with the rest of our marketplace. We're very much looking at it as an extension of our interest-free offer. And interestingly, and of course this is a very fast-moving sector, the largest take-up of buy now, pay later currently is supposedly in the 40 to 55-year-old bracket, which is inherently better quality profile customers going into the retail space. But ultimately in our business, at point of sale, for small balance transactions like ours, retailers are absolutely insistent on a very quick decision. They'd much rather you say no quickly than yes slowly. So we have to be very risk averse at that point, and that's exactly what all of our competitors do, and I think that's exactly where the buy now, pay later sector will end up. The only caveat to that is that the difference, in essence, with buy now, pay later than our existing products is the ability to repeat the transaction multiple times in a similar way to a credit card. And of course there you get to know the customers much better, so we think there are ways that we can actually insulate ourselves from risk from that perspective. One of the reasons why buy now, pay later was such a logical move for us was over the past few years as we've grown, and perhaps one of the best kept secrets about the retail business is we do have 840,000 customers. We open more than 50,000 new accounts per month as well. So there's a huge turnover of customers going through it. But our model has never been to focus on the customer themselves as the end result. So what we've been discovering as we've been mining that data is that, unsurprisingly, people who have used V12 in the past, when they can see it on offer again, will use it on a second and a third and a fourth time. So that's given us more insight into the credit risk for those types of customers, which, as you might expect, is better because we've seen them once and they've repaid the loan.
Pick up on the maze.
I can't remember what the question was on the maze.
No, it's basically, is there more on the table on the maze assumptions?
Yeah, sorry. Yeah, I mean, I think we've indicated before we are probably conservative in terms of our MES, and we are obviously eagerly waiting for the MPC tomorrow as well to see whether or not unemployment levels are still predicted to stay as they are. We obviously, as part of our year-end planning, will be reviewing those assumptions again, and I would say that we probably always will stay slightly on the conservative side rather than moving anywhere near to the more middle ground. So that gives us enough protection in terms of our provision.
Thanks, Rachel. And I do have one on the iPad, so it's vehicle finance, David and Kira. So vehicle finance is described as rate for risk, and it's easy to see how the proposition works from a service perspective. However, will it be competitive from a rate perspective, and doesn't the dealer have an obligation to deliver the best rate? And will prime lending be at lower margins? I mean, I can cover the last one, just a bit what you think about the first part. On the second part, I think we've been quite clear this, that what we've been doing, and you've seen in our full year and half year results, is as we've de-risked the lending that we have, particularly on the consumer side, then actually you are seeing some slight downturn in margin, but you're seeing the improvement on the impairment line. So we're very comfortable with that trend, that shift, and the returns that it still generates. But on the dealer rate for risk?
Yeah, so on rate for risk, that's kind of almost kind of two elements at the moment. Predominantly the prime sector, the seller of the vehicle and the finance will actually determine what the customer price will be for all of the customers. So there's almost a single price for prime. That's probably the most common model at the moment. So they will determine they want to advertise all of the cars at 9.9% APR or 12.9% APR. So there's no variation really in terms of prime at the moment. We do think that's probably likely to change because none of the other consumer lending markets generally operate in that way. If you're applying for a personal loan, for example, online, the rate that you get will be determined by your credit quality, and that'll be all through the prime spectrum as well as through near prime. On near prime, we come back with the APR, so it's not a advertised price. They've been declined for their 9.9 or 12.9 APR, and we then come back and say, for this particular tier of credit, it's 14.9 or 17.9 APR. But that's kind of how the model works. And in terms of margin, quite clearly, the near prime business has a higher margin. We're not seeking to be at the top end with the very big franchise dealer groups where the price and the margins particularly squeeze, operated by the larger banks really are the suppliers into that area. We're really trying to service the kind of the middle market where actually the margins are still attractive, but also give us the opportunity for scale, which is really important for our motor business. So the core business is still near prime, scale from the prime business, but in that middle sector, which we think offers attractive returns.
Thanks, David.
Just, David, the last wee point of that question was around, does the dealer not have an obligation to offer the customer the best APR outcome? Absolutely they do. So that just takes me back to, do you remember when I described the different F&I platforms that are available? That's what they do. You put those customer details onto that, and it sends a message out to all the lenders that may be on that panel, so the dealer can see who's going to offer the best rate for my customer, who's going to come back the fastest, and maybe who's going to give them the least onerous conditions of what they need to prove to be able to get that deal. So that's where those finance and income platforms come in, and it's why we've decided to integrate with them all so we can appear on all those panels.
Thanks. Any final one in the room? No, I think we're just about out of time. Well, listen, thanks very much again for joining those who are here in person, but also those online. I hope we've described today that we're at the start of an exciting journey, and journey of ambitious growth, and obviously we look forward to updating you more on that journey going forward at the normal reporting points in the calendar. But thanks very much again, and if you are able to stay for something to eat or a drink, then we'd be delighted to talk to you there. Thank you very much. Thanks.